Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Michael Hakes is on the show today. He's Senior Portfolio Manager at Murray Wealth Group, and we'll be taking your questions on U.S. and global stocks. Here's how you can reach us. You can call us toll-free, 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. And Michael Hakes joins us now. It's good to see you. Thanks for coming on the show.
Hey, Lindsay. Thanks for having me on.
Okay, so let's get right into it.
I'm safely in my office.
You're safely in your office.
I
know
office.
It's a good place to be today, particularly in Southern Ontario with the snow we've got out there. But it's been an interesting year so far when it comes to the markets, when it comes to what we've been seeing. You say you're still expecting growth for most of the indexes, particularly the S&P 500. Is that right?
Yeah, that's right. The S&P 500 still remains very healthy. Earnings growth for the year is expected to come in between 8 and 10%. That resilience will be bolstered hopefully by a stable job market and anticipated Fed cut or cuts, plural.
There is still some headwinds, though, that you see and some things to watch out for this year, obviously.
Yeah, that's right. The midterm elections are coming up, and that typically introduces a lot of policy uncertainty. We have the continuing overhang of the AI CapEx gap. With all these companies investing so strongly in these hyperscalers and data centers, and obviously the return where we last year had just give me AI exposure to show me the ROI. Mm-hmm. So that's the key for this year is in terms of turning those dollars into revenues.
I think that's the conversation a lot of people are having now, right? Especially with these big companies, as you say, we're seeing a lot of big spending. It's like, where is the return on that? How long do you think most of these companies have to show the return? How patient do you think investors will be?
We are being fairly patient. When you look at the hyperscalers CapEx, what it was last year in 2025 was around $440 billion. Well, in this last quarter that is reported, Q4, those numbers have come up dramatically, $750 billion in 2026 and $900 billion in 2027. Some people have like over $1 trillion as we approach 2030. And those CapEx numbers have got to translate into profits for these hyperscalers. And typically, hyperscalers would show 2 or 3 times their trailing CapEx in terms of profits over the next several years. So if we look at current estimates for profitability for these guys, they have to come up dramatically in order to support the ROIC for these hyperscalers.
So with that in mind, anywhere you think investors should be looking as we head further into 2026?
I think what people have moved from is speculative hype last year and moving to measurable productivity. Generative AI is going to help out with more to do with cost efficiency and margin expansion rather than pure revenue growth. We've seen over the news in the last month or so, how companies are benefiting dramatically from being able to lawyers and accountants and who knows what have all dramatically been able to improve their productivity through using these tools.
Okay, we're going to take a quick break here. We'll be back, of course, with Michael Hakes right after this, taking your questions on U.S. and global stocks right after the break. Stay with us. Welcome back to Market Call. Michael Hakes on the show today, taking your questions on U.S. and global stocks. And we'll start with an email question. This one is coming in from Bill, and it reads, I'm thinking of purchasing Kimberly-Clark and would like your opinion, please. Okay, so Kimberly-Clark Corporation. Michael, what do you think about this company?
Okay, thanks a lot for the question, Bill. And it's a good one because there's lots going on at Kimberly-Clark. They are, traditionally, as we know, a global leader in personal care and hygiene. But it's going to make a significant transformation, and the company is pivoting from that broad paper-based products manufacturer to a high-margin, pure-play personal care giant. It also has a very attractive 4.5% yield. So those brands you may know are Pull-Ups, Kotex, Huggies, Kleenex, that sort of thing. But they're about to execute some important strategy shifts, and the first one of those is They're buying Kenvue. Kenvue is the former Johnson & Johnson consumer health business, and they have brands like Tylenol, and that deal is supposed to close in the end of 2026. They're also divesting their pulp business. The pulp business has always been a volatile commodity, and that's always weighed on the Kimberly multiple. And to add to these execution and strategy shifts, are also have a lot of efficiency and innovation programs. But the biggest overhang is the acquisition of Kenvue, because there are a lot of there's a lot of litigation, a lot of lawsuits against Kenvue with regards to their historic ownership of the talcum powder, and also Tylenol. Tylenol is also owned by Kenvue, and they have some litigation regarding autism claims that have cropped up over the last 6 months or so. But if you're willing to hang on and flip that 4.5% coupon, and those litigation risks get resolved, and the company's able to spin off its pulp business, you could see a higher multiple, and the stock could work quite well.
Okay, good to know. We're going to go to the phone lines now because Joe is calling in with a question. Hi, Joe.
Hi. I want to ask you, I guess, about Bank of America. I like his outlook for the company depending on any Fed rate changes, the midterm elections, and also will there be any dividend increases in the horizon for the U.S. banks after the last financial collapse when all dividends were kind of capped by the government? Thank you.
Okay, a lot of good questions there. Thank you. Dividend right now is about just over 2%. First off, what do you think of Bank of America?
Yeah, dividend yield 2.3. Most of the banks, including the Canadian banks, have all rallied strongly over the last year or so, Bank of America being one of them. They all trade, they all have much lower yields, broadly speaking. In terms of what's next, as we look towards the midterm elections, typically Republican governments are good for deregulation and that sort of thing, lowering your capital requirements, which would allow the banks, Bank of America being one of them, to invest more money and grow faster. So that would be positive for them and the whole group. We own Morgan Stanley. It's a little bit different, the mix of business, but the banking business is for Bank of America this year, I'm sure, is very strong, as we've seen the IPO pipeline open up this year versus last year. So I think Bank of America is probably a solid hold right now, if you own it now. And
I know Joe, calling in from Montreal, was also asking about the changes at the Federal Reserve, potential rate cuts on the way. Does that factor into any of your feelings about Bank of America or other American banks right now?
Yeah, it's a lot of noise. It's not noise because it's real, but Fed cuts would help Bank of America. Just by supporting the overall consumer and bank lending that way. So that would be positive for stocks, broadly speaking, and also Bank of America. Yeah,
I take your point. It's not noise, but there is a lot of talk right now. There's a lot going on. Okay, we're going to switch now to Paul, who's calling in from Edmonton with a question. Hi, Paul.
Hello. Yes, my question is on Walmart. I bought a small amount of Walmart stock in my cash account about 10 years ago, and Walmart, has gone way up in price since then. Normally, I am a do-it-yourself buy and hold investor, but Walmart's price-to-earnings ratio has gotten so high, I wonder if I should sell my Walmart or just continue to hold it. What would you advise?
Okay, thank you so much for your question. We're looking at a 3-year chart of Walmart right now. What do you think?
Yeah, Walmart has performed very, very well and made a transition to e-commerce, is essentially why the stock has been on fire in a good way. They've added e-commerce to their platform much better than they have historically. So if you own this for 10 years, it's been a home run. The top line growth is only growing at 4 or 5%, and we debate Walmart all the time. But the multiple, as your point is trading at 44 times 2026 earnings, extremely expensive. It's like along the multiple of Costco, but when you, for example, put that up against an Amazon, which would be a similar business, Amazon is growing faster, both top line and bottom line. But Walmart has been seen as really more of a safe place to park your money while they execute their plan.
Okay, we're going to move to our inbox now. We've got an email question coming in from George. It reads, can you please ask your guest if Intel is a buy, sell, or hold? Do they have a position in Intel? So, Michael, thoughts on Intel?
Yeah, Intel is, we are cautious on Intel because it, again, is a very expensive stock. If you look at it on this year's earnings, trading at about 100 times PE. And we think it's discounting a lot of good news and flawless execution over the next several years. You got to remember that Intel is what they call an integrated device manufacturer. And this means that they own these massive fabs, semiconductor fabrication plants, and they manufacture the chips that they design. And that's unlike NVIDIA, which designs their own chips, but then it pays others to build them for them. Intel currently has about 15 fabs, I understand, but they have a new strategy. They have launched what they call an Intel Foundry initiative, where they build their own new fabs. They have one in, I think, Ohio, in Germany, and a few other places. But now they're opening their doors to competitors like Amazon and Microsoft, where they're going to build their chips for them too. So Intel wants to become the second largest foundry by 2030, which will put them right in the line of sight with TSMC, Taiwan Semiconductor. So there's a lot of exciting things going on at Intel. But I think it's the stock has gotten ahead of itself here, especially with the U.S. government investment, which leads you to believe that any decision that the government makes will be favorable towards Intel.
Okay, we'll have to wait and see what happens there. We're going to take a quick break right now, but we will be back with Michael Hakes of Murray Wealth Group, taking your questions on U.S. and global stocks right after this. Stay with us. Hi there. Welcome back to Market Call. Michael Hakes with us today, taking your questions. We're going to go straight to the inbox once again. Henderson has emailed us a question, and it reads, I would like the guest's opinion as to what is happening with BDX. That's Becton Dickinson. Okay, so Michael, Becton, what is happening with Becton right now?
Yeah, thanks a lot for the question, Henderson. Like Kimberly-Clark that I just talked about, Becton is going under some significant structural changes. Just last week or a couple of weeks ago, the company officially completed its spin-off of its life sciences business. And at the same time, they merged with Waters Corporation. So big changes happening at Becton. The company is sort of transitioned to what the management calls a pure play medtech company. This new Becton is more concentrated, focusing on higher growth, higher margin areas like pharmacy automation, connected devices, and chronic disease management. But what it means for you as a potential investor is that the new entity, last year, before the change, they were looking for, I believe, $15 in earnings. Now, since the structural changes, they're looking for about $12.50 in earnings this year. So the earnings numbers come down, but the operating margin expectations have gone up from about 21 to 25%. The market's really looking at it as a wait and see story to see if the management's successful on this. It's a fairly cheap stock, trading, I think, at around 14 times that new earnings expectation. So it's a wait and see. The street has about a $200 target on it with 13% upside, but lots of changes going on, which adds to the risk of the stock.
A wait and see approach, like how long, I asked this off the top about, just big mega cap stocks in general, but how long do you think investors will wait, really? Like where's the patience threshold?
Oh, right. So for Becton, it will be a show me story. So they will have specific milestones that they have to achieve. Going back to your other point where you're looking at the hyperscalers or anything, that is something that there's no definitive, I think, pin in the sand where, oh my God, everything is okay with this company, because it's going to be slow and steady generative AI kind of intrusion into our daily lives.
Right. Okay. Great. Can't wait for that. We're going to go to the phone lines now.
In a good way.
In a good way. Luis is calling in from Toronto with a question. Hi there. What's your question?
Hi. The question is, how will the cancellation of Kuzma affect Telus? Tens of thousands of jobs are potentially going to be lost. Canada has been flooded with immigrants. All these people are going to leave Canada as jobs evaporate. How will this affect Telus' stock?
Okay, thanks very much for that question. Telus sitting right now a little lower the first half of the year. What do you think about Telus, Michael? And again, with the upcoming Kuzma negotiations, how does that affect this company?
Yeah, it's there was lots of moving parts. Broadly speaking, all the telecoms are helped by increased immigration. Because you have more people coming into Canada. They need to have services, phone services, specifically cell phone services. So they all broadly benefit from that. So now we've clamped down on immigration. And to the caller's point, people could be leaving. So that would be bad, because essentially for Telus and Bell and all these players, they have a pool of people that they have to encourage to buy their services. And now that pool is potentially, to the viewer's point, decreasing. Whether or not that actually happens is another thing altogether. But essentially, it's a very mature business. You have X number of people who want phone services, Telus being one of them. So it's a mature industry. Telus also has just announced a new CEO. They've pretty much said they're going to keep the dividend flat in terms of dividend growth, but the market is expecting them to cut it now. And I think the former CIBC CEO is taking over from Telus into Telus now. He may set the bar lower, not lower, but he may cut the divvy, satisfy the market, and focus on the debt pay down.
All right, we're going to move on to another caller. Kevin is calling in from Kingston, Ontario, with a question. Hi, Kevin.
Hi there. Thank you for taking my call. My question is on Visa, which I guess the same as Mastercard, same business. I've been an investor in both, more so Visa, since 2008, the year of its IPO. And I follow them both very, very closely. But I'm very disturbed as to their performance over the last year and a half. They have not kept up to the S&P 500. And this is very unusual for both of them. And I know that a lot of people are concerned because these are growth stocks, but they're not performing this way, and something is wrong. And I would like your opinion. Thank you.
Okay, thanks, Kevin, for that question. So, Michael, I guess I'm not sure if you can talk about Mastercard, but let's definitely start with Visa there. Do you think something's wrong with this company in terms of how they've been performing?
No, I think the viewer is hitting the nail on the head there. There's nothing really wrong, but the overhang has been all about cash, digital payments, and potential disruption. We own Mastercard in our global growth portfolio, and it is down, to your point, is on Mastercard side, it's down 5% year over year. So they've definitely lagged. The multiples come down. We still like Mastercard. Visa, as to your point, is pretty much the same. They have different exposures across geographies, but essentially they're benefiting from the broader theme of moving from cash to credit. And then it's a question of whether or not digital payments, whether it's stable coins or something like disrupts their rails, as they put it, and someone else and a disruptor comes in, because that has been really the headlines over the last 6 months as to how they're going to be disrupted. But we feel they're going to come out of this still looking good. Both Mastercard and Visa, they're both growing revenues 10 or 11%. Same. Pretty much the same, not a lot of leverage in the model, probably 15% earnings growth. And they trade at roughly, not a stretch of valuation, 22, 23 times earnings. So we're positive on both Visa and Mastercard.
Okay. We're going to go back to the inbox now. Andy has emailed us with a question. It reads, what is your guest's opinion about Microsoft at current prices for the short to midterm? So 6 to 24 months is what he's saying in brackets. Microsoft about $401, $402 per share right now. What do you think about short to midterm for Microsoft?
Yeah, we think this is a great entry point for Microsoft. It's only trading at, when you look at Visa trading at 23, 24. Microsoft is only trading at about 22 times earnings. And for that, you get 15% both revenue growth and EPS growth. So it's super attractive here. And to our discussion earlier, it's really been caught up in that show me the ROIC story. As a company continues to increase dramatically their CapEx spending without the equivalent amount of, in their case, Azure revenue growth, even though the last quarter saw about 39% Azure revenue growth in a quarter, which was unfortunately for Microsoft about 2 percentage points below the Whisper number. The Whisper number is always important to try and beat. So they came at 39 versus 41. So that always upsets all those fast money people on the street. So we like Microsoft here.
So you think it's a buy right now?
Forward. Yeah, I think you have to keep the business in mind. They've got that Azure business, which is growing at 39%. Then they've got the productivity and business processes side of the business, which is Microsoft 365 Copilot, which now has over 15 million paid seats. But the key is going from that 15 million and ramping up to 30 or 40 million over the next year or two, because everyone sees, to my point earlier, productivity savings for whatever business they're in, utilizing Microsoft Copilot.
Okay, Michael, thanks for that. We're going to take another quick break. When we return, though, we will take a look at Michael's past picks. That's coming up right after this. Stay with us. Welcome back to Market Call. Michael Hakes is joining us today, and we're going to go through some of Michael's past picks from May 9th, 2025. So we'll start with UnitedHealth. It's obviously been a bit of a bumpy road for this company. When you recommended it was at $380 or just over, now at $289, total return of 22% or minus 22. So are you still holding this one?
Yeah, we are. It has been, as to your point, a bumpy road for UnitedHealth. We think it's under-earning. We thought it was under-earning last year. Now we think it's really under-earning, but there have been some changes over the last 6 to 12 months. But the biggest weight on the stock has been the Trump administration's proposal for flat Medicare Advantage rates in 2027. They are proposing a rate increase of basically 0.1%, whereas the street and analysts were expecting about 4%. So what that does is it really, when you combine that rate increase with medical cost inflation, it really puts the pressure on, in this case, Medicare Advantage and UnitedHealth, and basically creating a lot of unprofitable business. So UnitedHealth is trying to right-size that business now. They expect their 8.4 million members now to decline as they prioritize margins over growth. So if you believe over the next 2 years, which this year will be a reset, next year they reprice their insurance products, we should see better growth in terms of both the top line and bottom line. And as if we look out to 2028, and could possibly see a $23 earnings number. And if you go back, they were approaching $30 3 years ago in terms of earnings, but they've had a few hiccups, well-documented hiccups across the time frame. If they can get to $23 again, the confidence in the stock will come back, and potentially you'll see it closer to 400 or 40, almost 40% higher.
Okay, well-documented hiccups is a good way of putting that. We'll move on to your next past pick. That was Accenture. So what was recommended at $370, just over, now at $218. What about this one? Are you still holding this?
Yeah, we still own Accenture, and we do like it, but the stock's decline has been much worse than the actual financial performance. EPS expectations over the last year have only come down about 5%, but the stock has performed much worse because it's been caught up with these fears that we talked about earlier of Gen AI disruption, and its valuation has massively re-rated down to about 16 times earnings, where its last year was trading about 23 times, which would be in line with its historical safety go-to kind of stock. However, when you look at Accenture's main business, traditional consulting, that has been affected by macroeconomic concerns. So last year we had a higher for longer interest rate mentality, global policy uncertainty. Both those things were leading clients to pull back on discretionary spending. So you had consulting business only grow by about 4% last year. And you also had a cannibalization effect where there's growing evidence that AI is, quote unquote, eating the consulting model. You don't need to have armies of junior analysts go into companies and process stuff like data mapping and code migration. That's all being automated. So, but Accenture has retrained their workforce. They've made some layoffs. They're right-sizing that part of the business to these new realities. And they also, of course, have a Gen AI consulting business, which is a growth engine for them. in the last quarter, they doubled their Gen AI consulting business to $2.2 billion. So they are making strides on that side. And we still hang on to Accenture. It's historical valuations, if they mean anything, means that they've historically managed their way through disruptions before.
Okay, your last past pick, LVMH, correct me if I'm wrong, I believe this trades on the CAC 40, so this one doing better, recommended at £495, now at 526, total return of 7%. Tell us more about LVMH. You still like this one?
Yeah, 1 out of 3 ain't bad. So we've got LVMH is the luxury goods behemoth. We continue to like it at these levels, and it still has headwinds. They have trade pressure from both the tariffs in the U.S. and China. It's trading an attractive valuation at 21 times this year's earnings. We expect those earnings to go back up into the double-digit growth range in the next 12 to 18 months. The world has been slow to move back to luxury, but we're hopeful for the stock over the long term.
Okay, we're going to take another quick break right now. We'll be back, though, with Michael Hakes of Murray Wealth Group, taking your questions on U.S. and global stocks right after this. Stay with us. Welcome back to Market Call. Michael Hakes taking your questions today. So we're going to go straight to the phone lines once again because Kai is calling in from Toronto with a question. Hi there. What's your question?
Hi, good afternoon. Michael, my question is on Netflix. It's been on my watch list for a couple of years. I've never pulled the trigger and was after the recent, pretty large sell-off. I'm just wondering if your opinion is it bottoming out here, or is there still too much noise around the acquisition of the other streaming services and the regulatory hangovers and such? So your opinion on Netflix, please. Thank you.
Okay, thanks very much. Yeah, you can see that graph. It did bottom out, as Kai said. But what do you think about Netflix now, Michael?
Yeah, thanks a lot for the question. It's one we've been circling. We have owned it historically. We don't own it now, but it's clearly much more attractive down to the $77 level versus the $130 or so earlier. And it's trading at a reasonable multiple, 24 times earnings. It's growing this top line at 12-13%, and its EPS even more in the 20s if you believe the street in terms of estimates. So it's very attractive. And actually, when you think of them as the behemoth, they are the go-to streaming offering out there. And then you have the second and third tier guys, Disney Plus and Amazon and the others. But the overhang, I think, it's not even an overhang. I'm not even sure what it is. It's actually a good opportunity for them to buy Warner Brothers Discovery. And you see it a lot of in the media where you've got Paramount and Netflix continually to joust for this asset in terms of Warner Brothers. But the actual offering is different. The Netflix offer, which is a friendly merger, they're only trying to buy part of the business. They're offering to buy the streaming business, and they'll spin off the traditional TV business after. Whereas Paramount's offer to buy the entire Warner Brothers business, which includes the TV and all sort of stuff, old school assets. So the offer is slightly different for the two. Obviously, Trump has weighed in on this, like he does on everything in terms of opinion. So you're definitely going to come up under regulatory scrutiny. That'll take a long, long time. So there's no overhang for that. To your point, that's why the stock is going to go on forever, a year or two as it goes through the regulatory channels. But at these multiples, Netflix is looking good. They've been so good in terms of executing new programming, leveraging foreign programming into different markets. So we like the bottom underlying fundamentals of Netflix.
Okay, yeah, and that shareholder vote coming up March 20th, I believe, for Netflix and that friendly takeover bid you mentioned. So we'll have to watch. As you say, it is an ongoing story. We're going to go back to the phone lines. Robert is calling in from Burlington, Ontario, with a question now. Hi there.
Good afternoon. Michael, I'm holding IBM. I held it for several years, planning on continuing to hold it because I think the company is still undervalued. But if you were to take the larger companies in the current technologies, like being artificial intelligence and upcoming quantum computing and robotics, would you place IBM in the top 10 or outside the top 10? And I'd like to know your rationale for that. Thank you.
It's a good question. Okay, thanks for that. Michael, what do you think in terms of IBM being in the top 10?
Yeah, that's a great question. You'll have to forgive me if I can't think about my answer immediately, but I'll just give it a shot. So I think you should hold on to IBM. But in terms of being in the top 10, I'm not sure if you put them up against Microsoft or Dell or Oracle or Cisco or these other guys. They're pretty much growing at the same rate. If I look at IBM growing roughly at about 4 or 5%, Cisco at 5.8%. So they're in the ballpark. Whether or not how much they're going to be exposed to, I think you referred to robotics. I don't know what their exposure to robotics is. So that's a good question. If I look at the street estimates, they're pretty positive on it. They see 20% upside. They have about a $314 price target on it. So they could potentially participate in that whole new. You said robotics, and one other thing I can't remember what it was, but they're definitely.
I don't remember either. So, apologies.
Yeah, but it's not. It's the PE is not that aggressive. It's about 20 times earnings, so it's not super expensive, and their margins are expected to stay healthy at 60% gross margins, net income margins closer to 20%. So that's it's a healthy business.
Okay, thanks for that. Hopefully that answers the question. We're going to go to an email question now. Colleen has emailed us from Sarnia, Ontario, and she writes, what do you think of Apple and how it has held up against its tech peers? Okay, Michael, fire away. What do you think of Apple, especially compared to its other big tech peers?
Yeah, this is a great question. We don't own Apple. We haven't for quite a long time. We've always been aware and concerned about their hardware business versus their recurring revenue services business. And we've always had a problem with their challenge getting over their multiple of 30 times for maybe mid to high single digit revenue growth. But you're right, they have done very well. They're not betting the farm on CapEx for Gen AI. They're partnering with Google, Gemini to roll out their intelligence services on their new products. So maybe they're doing the right thing in terms of that. But I wouldn't just because we don't own it, I wouldn't say I wouldn't buy it. It's just not meeting our price target upside. The Street thinks Street has about 10% upside to Apple's current price.
Okay. All right.
I'll hold it.
Hold it. Okay, we're going to take a quick break right now, but we will be back with Michael Hakes of Murray Wealth Group taking your questions on U.S. and global stocks right after this. Stay with us. Welcome back to Market Call. Okay, so Michael, we're going to go straight to the phone lines. Richard is calling in from Oshawa, Ontario, with a question. Hi, Richard.
Hi. Thanks for taking my call. I'm inquiring about BYD. Since the Canadian government is allowing the import of Chinese EVs, I'm just wondering if this would be an opportune time to buy into that company. The stock price seems quite reasonable. Michael, what do you think? Thank you.
Thank you. Yeah, this is going to be a very interesting time starting March 1st. Michael, what do you think about BYD?
Yeah, BYD is the go-to Chinese auto manufacturer. They could possibly benefit from the changes in Canadian importing electric vehicles for sure. It would probably be a very small part of BYD's ultimate revenue growth. But if you look at BYD as a whole, expectations for their revenue growth is anywhere between 10 and 15%. So a healthy growth as they, for example, of Ontario and Canada, growing their footprint here, growing their footprint around the world and in Europe with their electric vehicles. China is way ahead in terms of autonomous vehicles. So they're making great inroads in their own markets. You can see earnings growing, I believe, in the double-digit range for next year, and only trading at roughly 20 times. So BYD is very interesting here because China is so far ahead. Less regulations in terms of allowing electric vehicles to hit the road. They're getting a lot more experience than the North American guys. So BYD is super interesting.
And as you say, it's been kind of flooding the markets in Europe, also in Brazil, but you don't think that there's going to be too much movement in the stock when Chinese EVs are allowed in Canada. Oh,
yeah. Well, actually, looking at this, analysts on it are expecting big things out of it. I think they have almost 30 to 40% upside. If I look at the consensus, so there is a lot of optimism in BYD for sure.
Yeah. Okay. That's going to be very interesting to follow. We've got an email coming in from Amy in Regina, and it reads, "Do you like Scotiabank for a long-term hold?" Michael, what do you think?
Yeah, we like Scotia. We've owned Scotia for quite a while now. The yields have come down dramatically on all the Canadian bank stocks. Scotia has the highest, almost the highest yield of the group, 4.3 or so. Most of the rest of the banks are all below 4, but Scotia still has some work to do in terms of the Latin American operations, right sizing those. But the whole bank complex has gone up over the last year. So it's definitely a long-term hold, depending on what your ultimate goal for your money is. But we like Scotia.
You like Scotia. Okay, we're going to go to another email question. This one is coming in from Sid in Victoria, and it reads, would you invest in Boeing or Lockheed Martin? Is there one of these two companies, Michael, that you prefer?
We don't own either of them. We have been talking about Lockheed. Boeing and Lockheed are probably different animals in terms of exposures. Boeing is coming obviously off a very, very difficult time in terms of their culture, their relationship with the FAA, their turnaround, all the planes that were grounded. We all know those issues.
Yes.
So it's a very tough road for Boeing. However, they're coming out of the bottom, hopefully. I think they just announced they've been able to increase their production levels over the last week or so. That's very positive. Their free cash flow may be improving, which is good. Lockheed Martin is growing at a slower rate, at about 5% versus that Boeing up 14, but 14 is a very, very low level. The mix of business is different. Lockheed probably has much more exposure to defense. You're probably buying a different thing. Obviously, there's robust spending on defense.
It's hard to compare the two, is what you're saying, right? In terms of which one you'd prefer.
Yeah.
Yeah. Okay. We will leave it there then. We're going to take a quick break. When we return, we'll take a look at some of Michael's new top picks. That's next. Join us tomorrow on Market Call. Greg Newman will be on the show. He's Senior Wealth Advisor and Portfolio Manager at Newman Group Scotia McLeod, and he will be taking your questions on North American equities. And if you miss Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. Okay, it is time now for our top picks with Michael, and he joins us now. Michael, we'll go through these. The first one, a company based in Brazil, very much expanding. Is it New Holdings?
Yeah, that's exactly right. It's commonly known as Nubank, though, and it's one of the largest digital banking platforms and leader in the Latin American fintech space. They are based in Brazil, as you mentioned, and the company has grown from a single no-fee credit card product in 2013 to a full-service financial powerhouse with over 127 million customers. And they've added products such as free digital checking and savings accounts for both individuals and businesses, personal loans, payroll loans, buy now, pay later type products, life insurance, so they have a partnership with Chubb, and international remittances. They are now spreading out through Latin America. They're in Mexico, they're in Colombia, and they're expanding to include travel as well. And they've just received conditional approval in January for a U.S. national bank charter. And I think one of the things I wanted to point out for Nubank is their key advantage of a digital bank, broadly speaking, is their cost structure. A digital bank doesn't have any physical branches, and this allows their cost structure advantage that traditional incumbents just struggle to match. Like the cost to serve for Nubank, a monthly active customer cost to serve is about 90 cents. And that's significantly lower than a traditional bank, which can cost more than $10 to $20 a month cost to serve. They are also very good at leveraging proprietary data and credit underwriting, and this allows them to lend what previously was an underserved population and still maintain their controlled delinquency rates. So they've been very disciplined in that and have a track record. We can see their top line is going to be growing at about 20% because the business is so leverageable. No people, no branches. EPS can grow at the 25 to 30% range. And we think the stock will grow at similar rates over the long term.
Okay, next up is Thermo Fisher Scientific. You say this is the Amazon of life sciences. Can you explain that?
Yeah, it is a massive diversified giant that provides infrastructure, consumables, and services required for the biological research industry, drug discovery, and clinical diagnostics. But they were also reliant on three major buying pools, and those pools have been weak over the last year or so, and they've seen pressure from the biotech funding crunch. And it has improved recently, but with higher interest rates, that made capital more expensive for pre-revenue biotech firms, and this led to conservative spending on their Thermo Fisher's high-end analytical instruments that Thermo sells. The second roadblock has been China exposure. China overall has been softening, but China has also introduced a new initiative called volume-based procurement, which basically says, everyone give us your best bids and prices for a certain product that they want to distribute through the healthcare system. And it's put a lot of pressure on Thermo's pricing and margins. So they have to get over that, and they're working towards that. And the third roadblock or difficulty they've had over the last year is in the U.S., we've seen academic and government delays in terms of funding research and their budgets. So that's been an overhang too. But what we like about Thermo, why we think it's going to go higher from here, is that they have a good recurring revenue stream. Almost 50%, maybe more, of their revenues come from recurring revenues, consumables and services, for example. And they have global scale. These guys have spent the last 20 years acquiring small niche players in different markets. They have dominant market positions now. They have unmatched supply chain, and they have a significant moats against smaller competitors. So the company will see expect revenue by 2027 reaccelerating to 7%. And if they should do that, the stock could perform very well.
Okay, we don't have a lot of time here for the last pick, so we'll get right to it. It's Amazon.
Yeah, save the best for last. We think Amazon is really, really great at these current levels. They have the overhang of the hyperscaler disease, as in they're spending too much money with no ROC yet. But we see a light at the end of the tunnel for Amazon. They have seen AWS, which is our cloud offering, growing at 25% in the last quarter. Advertising revenues, their other division, is growing at 22%. Retail and logistics, their traditional business, has been reorganized in terms of a regional fulfillment structure. That's going to improve their margins too. Amazon is relatively cheap, trading at 25 times, growing revenue at double digits, EPS at double digits. And when you look at that versus a Walmart, which we talked about earlier, trading at 44 times earnings with only a 5% top line and 10% EPS, Amazon is very attractive.
Very good. Okay, we are out of time, but Michael Hakes, so great to have you on the show today. Thanks so much for coming on. Appreciate it.
No, thank you.
Thanks, and thank you for watching Market Call. We will see you next time.